So some of the companies on the street, such as Bank of America, Merrill Lynch, see some sort of a pullback in the market of anywhere between 5 to 10% if the tariffs that we have stay in place. However, if we go full-blown tariffs on $500 billion worth of Chinese products and services sold into the US market, Bank of America estimates downfall in the S&P 500 of anywhere between 20 to 30%. I just want to put it out there so you know what some companies think the end result of that trade war might bring about. But then again, we all need to remember that heading into 2020, the elections in the US, I don't think that the Trump administration wants to see the US economy losing footings. In fact, I would make an assumption that the administration wants to talk up a strong economy at home. And same goes for the Chinese. I think in their best interest is to try and stabilize their economy. Therefore, I don't necessarily see a 20 to 30% down market in light of what's happening right now between the US and China. The stock market right now is pricing about few months of delay in the trade agreement with China. But that said, I wanted to speak about some of the risks that are out there in the event that this trade dispute with China is going to take a lot longer to resolve at the end. So one risk that we might think of is that trade tensions with China can send markets naturally into a tailspin. And to answer that worry, I would say that as long as the Federal Reserve stays on hold and remains dovish, I think they provide to the market some sort of a safety net. Other risks might be that these trade tensions should bring about a slowdown in the global economy, especially in the US. But then again, putting these trade conflicts in perspective, we need to remember that the US economy is at about $21 trillion in size. According to many analysts on the street, that will take away from our GDP growth rate about 2.4%. And that will take about 4% of the Chinese GDP growth rate. I don't think this is tremendously material to an economy as big as the US. Also, surprisingly enough, I read over the weekend in Barron's that the global growth right now is 3.6%. And it is down from previous years when the global growth was at 3.7%. The most interesting thing about these two numbers is that when the global growth was at 3.7%, trade with China was at about 7%. Now trade with China is a little bit over 2%, and global growth is still at 3.6%, not that far off from 3.7% in the past, which means, to me, if you look at the numbers, that trade dispute with China cannot be that bad in general to the US economy. Few other risks to consider are that China might use its currency as a weapon. In other words, they might devalue their currency. Last time they tried to do that back in 2015, $700 billion of their own currency fled the country. And if they were to devalue their currency to service that debt, it would be a lot more expensive for a lot of the Chinese companies operating in China. And the last risk to consider is that China might dump our treasuries. We call it the nuclear option. And I don't think that is another good option for the Chinese, in my view, because even if they were to dump their entire treasury holdings, which is about $1.1 trillion, again, looking at the total US Treasury debt, which is not something to be proud of, but it stands at $22 trillion. So a little bit over $1 trillion as a percentage of our total debt, $22 trillion. It's not a lot, and there are a lot of buyers out there willing to buy our debt because the alternatives to US Treasuries are not that great. If you were to buy German debt or Japanese debt, guess what? You're going to collect negative interest rates. Therefore, I don't think the nuclear option is really an option for the Chinese. This news, although it is not something that we should welcome, but on the other end, it might give us a better buying opportunity into the marketplace.
There's been more and more talk about the Feds having more reason to drop rates. If those nuclear options were to hit, I would think that the way we would respond would be a drop in interest rates, because I don't think the Feds want to go into a recession. So I just think that that's our backstop. And what is China's backstop? I don't think they have one, because they played all their cards. They manipulate their currency. They do all the things that all this spending they're doing internally. They've got cities over there with huge amounts of debt that was floated to construct these cities of 1 million or more people that are empty. So they're sitting with all that debt on their balance sheet. So I don't know how they do that. The play that was made here was that we have a stronger hand than they do, and ultimately we'll come out of the other side of this thing. JP Morgan, I was just looking at that stock. The last 5 years, it's grown 40% a year, but still they trade at a PE ratio of 11, which is pretty low, and they have a yield of almost 3%. They are large into auto loans. Of course, they own Chase now too, along with that, so that brings them in to the consumer side of the banking. And what's interesting is they have a very low default rate on their loans. It's like 0.02%.
Okay, so we've already talked a little bit about the trade war with China. I will zoom in a bit on Huawei, who is the second largest handheld maker in the world, right behind Samsung, and with third being Apple. That sort of shaped up last year. Huawei's gone on record about their ban on Android, but they expressed that they will continue to support existing phones. They'll also apply security patches as well as updates just to ease users' fears about their existing service. So this has provided a lot of opportunity for handheld makers like Samsung and Apple, who were highly interested in. This really couldn't come at a worse time because of all the 5G activity that's going on that Huawei is likely to miss out on. 50% of Huawei's handheld sales are actually outside of China. A lot is going on with sales in Europe and the Middle East as well. They're likely to have crackdowns on these dealings with Huawei as well. Huawei has a lineup of phones called Honor. They're going to release their Honor 20 tomorrow, and again, it couldn't come at a worse time for launching this with sort of the bans coming. So a couple of solutions may occur. There's something called the AOSP, which is the Android open source project. And this is where they could actually use the open source version of Android minus all of the services like Gmail and G Suite, and remove that and use Android's operating system at a bare bones basis. This all came from and was caused by Google's announcement that they suspended some of the services to Huawei, and that was in order to comply with the U.S. Commerce Department's directive that they recently issued. This is requiring that all the U.S. companies gain government approval before they do business with any of these Chinese companies on a certain list that was put together. And so following suit are some companies like Intel, Qualcomm, Xilinx, Broadcom, and this is likely to make a big impact and something we're highly interested in.
So just as a way of a recap, the yield curve that we watch so regularly, the reason that this is important is that a healthy yield curve, like we are currently experiencing between the 3-year and the 10-year and the 30-year, is a nice upsloping yield curve. When the yield curve inverts at certain breakpoints, you could get short-term rates that are actually generating higher returns than long-term rates. And historically, that's been a good indicator of a pending recession. So that's why we pay so much attention to the yield curve. So as I mentioned, we do have a healthy upslope between the 3-year and the 30-year. We do currently have some short-term inversions between the 2-year and the 3-year, but our concerns are more long-term. And so the inversion that we temporarily experienced between the 3-year and the 5-year back in December was notable, but that has not inverted again since. That currently remains at about 2 to 3 basis points, and the most important one, being the 2-year to the 10-year, has remained consistent at anywhere from 19 to 22 basis points pretty steadily.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. As always, if you like the content, please become a subscriber to our YouTube channel. You can also call us directly to our main offices in Woodland Hills at 818-914-7461. The highlight of the week is that although the trade war conflict is intensifying, I do believe at Tamar Securities and Firefighters United and 911 Financial Services that it's not a question of if, but when this trade war will come to a final resolution.